Hello and welcome to the International Energy Agency's technical webinar on regional insight from the World Energy Investment 2026 report. Ladies and gentlemen, global energy investment has climbed to $3.4 trillion. And today we really want to dig into this number, and we want to see the differences across countries and regions and really what is driving this. I'm Adam Ward. I'm going to be chairing today's session, and I'm joined by five of my colleagues who will be providing their expert insights into the energy trends across 6 countries and regions. I'm going to introduce each of them just before they present. So a quick word on the format. After my short opening, we will then have a presentation from each of my colleagues before we're going to move into the Q&A section. The Q&A is already open, so please do start to think of those questions as we present and do submit those. We're going to work very hard to collate them and really look forward to answering as many of them as possible later on. So the World Energy Investment 2026 has the usual top-class energy analysis within the regional chapter across 10 countries and regions. And this year as well, online, we've included for the first time regional dashboards. So this gives you an opportunity to go online and to see and explore the data that we have across those 10 countries and regions. Of course, we wanted to discuss all of them today, but unfortunately, we had a very difficult decision to make to only pick 6. But we've picked those to give you a good sense of economic diversity, so advanced economies and emerging market and developing economies, but also diversity in terms of geography. So with that, let me just provide a couple of overarching slides before I'll be handing over to my colleagues who will really dig into the details in a little bit more. So as I mentioned, global energy investment has climbed to $3.4 trillion in 2026, and clean energy investment is responsible for 2.2 trillion of this. And you can see on the screen there, looking at the distribution of this clean energy investment, we can see that it's around 50-50 between advanced economies and emerging market and developing economies. And we see that China is responsible for 30%, India for 5%, and then the other being responsible for 15%. One area that I wanted to highlight, which features in our interactive dashboard that we have online that I mentioned, is per capita investment. And we can see here the variance that we witness between advanced economies, so the United States and European Union, towards those in emerging market and developing economies, next being China, and then it really starts to tail off. And I wanted to highlight in particular Africa, which is responsible for 3% of global energy investment, despite having 20% of the world's population. Electricity has always been an important part of the energy investment picture. And in 2015, it was responsible for around 1/3 of global energy investment. And you can see, indeed, in some economies, major economies such as China, the European Union, and Japan, it was over 50%, also in Korea and India. But since 2015, spending on electricity has accelerated faster than other parts of the global energy economy. And thus, if we fast forward to today, what we can see is overall, the picture has changed in terms of half the investment now going into the energy sector is to electricity. And this is really driven by countries such as China, where it's climbed to 70%, despite being a much bigger overall investment as well, but also, the European Union being at 75%, the United States now over half as well. This isn't the only investment that we need to see, of course, and there are still gaps. And indeed, my colleagues are going to be digging into some of those in a little bit now. But the shift towards investment in electricity is structural, and it is likely to get even more momentum as we move forward. So with that, I first want to introduce Zoe Hermes, who will be presenting on the United States. Thanks very much, Zoe.
Thank you, Adam, and thank you to everybody in the audience for joining us here for this webinar today. So indeed, over the next couple of minutes, I will be presenting some of the analysis that we were able to do for the United States, and I'll first provide a little bit of context. So total energy sector spending in the United States is expected to exceed $600 billion in 2026, which represents a 6% increase relative to 2025. And of this figure, approximately 1/3 of investments are expected to go towards the supply of fossil fuels, as the country remains notably an exporter of natural gas. So as a result, the story of energy sector spending in the United States is largely a story of natural gas on both the power and supply perspectives, and that's what I'd like to dive into a little bit more today. So looking first at the supply side, the United States invested heavily into export capacities for liquefied natural gas, or LNG, in the first half of the 2020s. So what we're seeing here is the volume and value of final investment decisions for LNG export capacities in the world from 2020, and this represents the moment at which project sponsors chose to commit capital to their projects. So from 2020 to 2024, the United States and Canada reached final investment decision on nearly 100 billion cubic meters of LNG export capacity, the majority of which is located in the United States. And this was topped by a record year in 2025, when FID was reached for over 100 billion cubic meters of LNG export capacity, 90% of which is located in the United States alone. However, as we're all aware, the conflict in the Middle East and resulting closure of the Strait of Hormuz has also halted LNG exports from the Gulf. So what exactly does that mean for investment? Well, overall, we expect that global investment in natural gas supply will reach about $330 billion in 2026, which is the highest level that we've seen in the past decade. And one of the key drivers of this growth is a surge in spending on LNG export terminals, which is expected to reach about $50 billion globally, with the United States and Canada accounting for about 55% of the year-on-year growth from 2025 to 2026. And of course, this growth comes despite some delay in investment in the Middle East, as project timelines in that region are impacted by the conflict. And over the short term, what we've been able to see is that this upswing in LNG investment has really helped the world to weather the storm of immediate impacts on gas markets over the past couple of months, as new supplies, especially from the United States and Canada, are able to offset some of the loss of cargoes in the Middle East. However, over the longer term, this conflict has raised an important question for these LNG investments, especially related to the fact that these supply chain disruptions and resulting economic impacts have somewhat diminished the reputation of natural gas among the very consumer countries that are expected to be the main consumers for the gas industry in coming years. So here we're mostly thinking of emerging market and developing economies in Southeast Asia, which historically have been significant importers of natural gas. But the story of natural gas investment in the United States is not quite over yet. as the United States power sector as well is experiencing a remarkable surge in investment in gas-fired power over the past couple of years. So total spending on power generation in the United States is expected to exceed 140 billion US dollars in 2026, with natural gas alone accounting for about 35% of this total. And this represents a 63% increase in spending on natural gas power relative to 2025. So what exactly is driving that increase in natural gas power spending in the United States? And again, to answer that question, I will point your attention towards the value of final investment decisions, this time for natural gas generation in 2025 and the first quarter of 2026. So decisions to move ahead with new natural gas-fired power plants have risen sharply since the start of 2025 across the world, but this is very much driven by growth in the United States. And a key reason for this is the demand from data centers. So that applies both to grid-connected projects, but also to new turbine orders for on-site gas generation. And since the start of 2025, an estimated 28 billion US dollars have been committed to on-site gas generation at data centers. And just to put that a little bit into perspective, if US data centers were their own country, they would constitute the second largest destination for gas turbine orders in the past 5 quarters, from 2025 to the first quarter of 2026. And I think that this emphasis on on-site gas generation really demonstrates the value of speed to power for these data centers, as the access to electricity has become a critical element in enabling these data centers to become operational as quickly as possible. So we can see that, again, both from the power and supply perspectives, natural gas remains really a critical driver of energy sector spending in the United States. And I'll pass it back over to my colleague Adam to introduce the next speaker.
Thank you very much, Zoe, for that great overview there, digging into some of the aspects on gas to power and especially looking at the role of data centers. So now I'll turn to one of our other lead authors from the report, so Siddharth Singh, to present on India. Thank you.
Thanks very much, Adam. So India has been the fastest growing major economy over the last few years. In all of IEA scenarios, we find that India accounts for the single largest growth of energy demand over the next 10 to 15 years. So this is the outlook period. In this period, India adds about 10,000 cars to its streets every day. India adds over 300 million air conditioners to its homes. It doubles iron and steel production. It increases the built area by over 60%. So therefore, a lot of the activity in India's energy sector is expected to accelerate over the next 10 to 15 years. This also has implications on India's energy security as well as emissions globally. In fact, India would account for the single largest source of emissions growth over the next 10 to 15 years. As a result of that, tracking India's investment choices today becomes extremely important. It's vital to understand the choices that India is making as far as its mix of energy technologies go across the sectors of supply, power, and of course end-use demand. So what we notice is, firstly, that in 2025, in fact 2026 now, India would have reached an all-time high of energy investment of 170 billion US dollars. Like to do a little breakdown between the various sectors to see where this growth is coming from and what are the drivers for this growth. So firstly, on the supply side, India is a major importer of crude oil. In fact, India imports about 80% of its crude oil needs. But on the other hand, India is a net exporter of refined products, as a result of which India has a big fleet of oil refineries and is expected to see a 15% growth in the capacity of its refineries by 2030, as a result of which India has seen extremely fast growing investment in this sector over the last 5 years, having grown over 200%. Of course, oil and gas production, India is not a major player on this front. Nonetheless, India has had a set of reforms in its investment policies related to the sector. It's invited international players to explore deep water basins, as a result of which India is also seeing growth in its oil and gas production investment. And for as far as coal production goes, India is a major producer of coal and has a target of producing or rather extracting about 1.5 billion tons of coal by 2030, up from 1 billion today. On the power generation side, we find that low emissions sources of power generation is driving the growth in this sector. But we'll get to this in the next slide, so I will not spend too much time on it over here. Grids and storage is a critical one because India actually had a peak in its grid investment about 10 years ago, and has since then seen a plateauing of investment. But as far as 2026 goes, India is coming back to those peaks and therefore has seen about 140% growth in grids and storage investment over the last 5 years. India's efficiency investment have historically been quite strong as a result of its efficiency policies, and therefore we see continued activity in this front, especially in the industrial and buildings domain. Finally, as far as end-use electrification goes, India's electrification story has actually not been driven by cars, that is four-wheelers. Only about 5% of its cars sold are electric today. But on the other hand, as far as three-wheelers go, I mean, just for context, millions of three-wheelers are sold in India every year. Over 60% of them are already electric, as in the sales are electric. And India has also had a major success as far as railway electrification goes. In fact, India now has about close to 100% of its tracks are electrified. So you see a decline in investment here, but that's largely because India had a big surge in investment over the last decade, and India has now met that goal, and therefore investment may be falling, but it still accounts for a large share as far as its overall picture goes. Now, zooming in a little bit onto the power sector, we find firstly that coal and gas related power generation investment have largely been flat over the last 10 years. India did invest into building or rebuilding a fleet of coal-fired generation in recent years, but nonetheless, in 2026, the value is almost as much as it was in 2015, about 10 to 11 years ago. On the other hand, its investment in renewables and nuclear has been growing very fast. It has grown fivefold since 2015. As a result, for every dollar that's spent on coal and gas, India now spends around $3 in renewables and nuclear. Therefore, India's target of achieving 50% of its installed capacity coming from non-fossil sources, this target was for 2030. India already met that in the year 2026, meaning that now half of its fleet caters to clean power generation. Of course, this has led to some challenges, so I won't spend too much time on this, but India has a tendering system by which it crowds in investment on power generation for the renewable side. For the 160 gigawatt that was tendered out between 2015 and 2021, that's 7 years, 90% of it was just plain vanilla, either solar or wind. But that has changed dramatically since then in the last 3 years. Another 160 gigawatt was tendered out, but this time around 50% of it were either hybrids between solar and wind, or it included an element of battery energy storage, which in turn helps manage and balance India's grid a little better. So with that, I'll pass it back over to Adam. Thank you.
Thanks so much, Sid, for that excellent overview and drilling down a little bit more into the power sector. So with that, I would like to turn to Pat Modesise, who will now present on Africa. Pat, please.
So thank you, Adam. To give a little bit of a context for Africa, first, looking at the big picture, what we can say is that the global investment, energy investment in Africa is projected to grow by 11% in 2026, which is around $110 billion. And while this investment, I mean, this growth is mainly driven by the increase of investment in fossil fuel supply, we also have clean energy, which is picking up pace. And despite this projection, Africa represents only a small fraction of global energy investment, actually. And right now, we can see that coming to, I mean, if since Africa is representing a small share of the investment, we also have the total amount of spending, which is remaining actually well below its 2015 peak. Actually, what we have is 3% of the global energy investment in Africa, and despite this number, Africa is still homing 20% of the world's population, as you said, and we're still having energy access gap because we're having right now 600 million people lacking of electricity and 1 billion to clean cooking. And then on the demand side, what we can see is that clean energy is actually right now broadening, gradually broadening beyond utility scale power because we have the rise of solar PV imports right now, which is quite interesting in several African markets. And we also have the rise of the uptake of EVs, which is also interesting, but having challenges right now, affordability challenges, let's say, and also the fact that we have limited and weak network charging point that limit actually the deployment of the EVs. So more broadly, even if clean energy actually the investment in clean energy is increasing, has increased by 70% between 24 and 25. The upstream investment actually is remaining the largest portion of investment in Africa. So to be more specific, what we have $37 billion spent in 2025, and the investment map shows that it is highly concentrated between what we call the established producers countries. We have Algeria, Nigeria, Egypt, Libya, and Angola. Which represent around 70% of the investment and 80% of the production. And looking at the charts, we can see that across those countries, the investment trend have declined, except for Libya, which is actually a particular case because of the recovery that they're having from many years of conflict disruption base. So what we can say is overall, the message around oil and gas is the capital shift towards new development, because in the other hand, in contrast, we have also emerging countries which have where we have remarkable actually rise of investment because of the resource potential that they having. We can mention countries like Mozambique, like Ivory Coast, Senegal as well, Uganda, and yes. And then the overall message again is that the capital is shifting towards new development, capital-intensive project, particularly in LNG and deep water, which require higher capital upfront investment. And then before coming to the critical mineral section, I think it's worth mentioning the continuous reliance of many African countries on international capital, because despite the growing role of the NOCs that we've seen recently in countries such as Senegal, many of national oil companies are facing financing challenges, which actually define the fact that they are not that able to fund large-scale development. And then coming to critical minerals, which is a growing sector, we have actually many contributors. The first one is exploration. So as we see in the chart, we see that the growth is quite small, but is having momentum right now. The biggest contributor is, of course, greenfield investment, largely supported by copper, which represent around 90% of the global investment, especially in countries like DRC, Morocco, and Zambia. And as well, we have refining, because around refining, the thing is that we have first to mention that we have moreover than 13 African countries that have introduced new policies in order to support domestic processing and move up the value chain. However, we still have structural challenges that makes refining investment, that makes actually refining investment quite small. And I think, yeah, that's a key that can be considered as a yeah as a key as the key messages for Africa. Thank you.
Thanks very much, Pat, for that excellent overview and then the specific elements there for the oil and gas sector and also critical minerals. So now I would like to turn to Marta Gonzalez Rodrigo, and we're making her work extra hard today because Marta is going to be presenting on both Latin America and the Caribbean and the European Union. Marta, over to you. Thank you.
Thank you, Adam, and thank you all for joining us today. I will start with the Latin America and the Caribbean region. So, when we compare the energy investments between 2015 and 2026, we see that in 2015 the fossil fuels were dominant in the region, accounting for nearly 70% of the total. However, in 2026, we expect the total energy investment to reach 190 billions US dollars, where the share of fossil fuels has decreased to 53%. Spending on low emissions remain broadly stable during the decade, with a strong shift on the composition. In 2015, the hydro was dominant, which is the main source of electricity, source of energy for the electricity mix in the region, and now we're seeing like a strong growth in solar PV. Grids and storage has doubled over the last decade, reaching around 30 billion US dollars. The most significant shift we can see it in the end-use sector, where building and transport are responsible of this growth. As an example, we compare the sales in EVs in the region between the first quarter of last year with this one. We've seen a 70% increase. This sector are responsible of the strong growth in electricity demand. To get a figure, a number, we've seen that since 2020 it has increased an 80% of the electricity. So now we will get back to the fossil fuels with a focus on the oil production investment in the region. Brazil is the leading market. We've seen like some shifts across the countries. Mexico is declining slightly while Venezuela is recovering. We also have seen that new approval projects in different countries such as Argentina, Guyana, and Suriname are mobilizing up to 33 billions, being important markets in the region. We can see that the role of public investment has been declined. Now, this year, the share of private investment is almost reaching 70% of the total in the region. Now I will move on to the European Union finance. Okay. So, energy investment in the region has experienced a significant growth over the last decade, from 200 billion to almost 450 billions expected to be spent this year. Investment in fossil fuels has declined. This reflects the commitment of the European Union to diversify energy supply and also like to decrease the fuel demand. It can be also reinforced by the efforts of the European Union to phase out Russian gas imports from 2027. At the same time, the region is accelerating the energy deployment and electrification, which is reflected with the strong growth in renewable investments in these recent years. We are expecting to see a total investment in renewables of about 100 billion. Similarly, grids and storage has shown a strong increase. Grids investment has tripled since 2016. It's important to note that while renewable costs are increasing, grids equipment are renewable costs are decreasing, and grids equipment are the costs are increasing. Grids are the backbone of the electricity system, so under investment can lead to bottlenecks and connection delays and other issues. So it's important to tackle this problem, investing more. We need to do it to achieve and support the electrification objectives of the European Union. So to address this, the Commission has allocated up to 590 billion to the European Grids Package, and also to reinforce and support the development on storage. They have created the Battery Booster Facility, allocating almost to 2 billion to support the development. Investment in electrification and energy efficiency has also increased significantly over the past decade, confirming the EU's focus on energy security and decarbonization. And to take a deeper look, let's turn on the electrification, which is a key enabler in the energy transition. So, investment in electrification and energy efficiency has more than doubled since 2015, reaching close to 180 billion in 2026. The main sectors driving this change is transport and buildings. Within the transport sector, EVs are playing a central role in the development. Across the system, the share of investment going to electrification has significantly increased from 42 in 2015, and now we're finding 75% of the total. So this reflects not only market trends, but also the impact of a strong and evolving policy framework. So thank you. Back to you.
Thanks very much, Marta, for those excellent insights, both the Latin America and Caribbean, in particular on the oil and gas sector. And I was very interested to see the shift between private sector and public sector investment, and then also the European Union drilling down there into clean energy and electrification. So last but no means least, we will complete our world tour with Lauren Chan, who will present to us on Southeast Asia. Lauren, over to you.
Great. Thanks, Adam. So Southeast Asia is one of the world's fastest growing regions, with electricity demand increasing around 6% per year over the last decade. And this is double the pace of overall energy demand. Energy investment as a whole is expected to surpass $100 billion this year, and of that, around $45 billion will be in power. So that's the first thing I'll focus on today. So coal has played a central role in Southeast Asia in providing baseload supply and ensuring system adequacy in countries such as Indonesia, the Philippines, and Vietnam. Volatility in gas markets driven by conflict in the Middle East has increased the short-term economic value of existing coal assets and has highlighted the importance of coal for energy security. However, this continued reliance is increasingly a legacy of the existing fleet rather than a signal of renewed investment in new coal capacity. So after strong investment in the 2010s, the pipeline for new coal has slowed down, with investment declining since 2018. At the same time, there have been efforts to support the region's transition away from coal, including through international public finance. So this decline in coal investment is happening alongside a shift towards low emissions technologies. Spending is expected to reach a record $22 billion in 2026, with growth across solar, hydropower, wind, and geothermal. Solar is the dominant technology in the region and surpasses $5 billion. approaching a previous peak that happened in 2019, where there was rapid solar deployment in Vietnam. Since 2020, the energy mix from renewables in the region has become a lot more diversified. A lot of countries in Southeast Asia has strong hydropower potential, and this requires capex-intensive spending over long time periods. And countries such as Laos and Myanmar export their surplus hydro to their neighbors. Geothermal potential is high in Indonesia and the Philippines, and so investment in these aspects are going up as well. And an emerging low emissions technology in the region is nuclear, where the most advanced nuclear plants are in Indonesia, Vietnam, and the Philippines, where governments are actively exploring deployment pathways and international partnerships. But the timelines for nuclear to come to the region remain long and uncertain. So this growth in low emissions power is driven by policy signals from Southeast Asian governments. For example, the ASEAN Plan of Action for Energy Corporation sets a target of having 45% renewable energy in installed power capacity by 2030, which will require sustained investment until 2030 across all of the technologies. This policy momentum has become a lot more relevant in the context of the Middle East crisis, as Southeast Asian countries are looking to expand domestically available energy sources and reduce their reliance on imported fuels. There are already early signs of accelerated renewables deployment. Solar panels imports from China to the Philippines have tripled in the first quarter of this year compared with 2025, and imports to the region as a whole have grown 150%. As generation investment grows, grid investment is becoming increasingly critical as well. Spending is set to reach around $15 billion this year as countries work to keep pace with demand and integrate growing shares of variable renewables. There is also momentum for regional integration through the ASEAN Power Grid, which could require around $27 billion in investment by 2040. However, as with other regions, grid expansion remains a bottleneck, so long development timelines, permitting challenges, supply chain bottlenecks means that grid investment still lags behind power generation. Moving beyond the power sector, investments in energy efficiency and electrification across buildings, industry, and transport will also be critical to meet rising demand for energy services. Buildings account for the largest share of end-use investment, driven by rising incomes, rapid urbanization, and expanding access to electricity and clean cooking. Growing appliance ownership, particularly for cooling, is a key driver for this growth. So while buildings account for the largest volume of investment, transport instead is the fastest growing end-use sector, driven largely by electrification. Investment in electric vehicles has expanded rapidly in the last 5 years and is expected to reach $6 billion in 2026, with strong growth across major markets such as Thailand, Indonesia, and Malaysia. These drivers are already translating into rapid market growth. So EVs have risen from around 1% of sales in 2021 to nearly 15% today. And in some markets, notably Vietnam and Singapore, EVs reached 40% of total sales. Southeast Asia also has the world's largest two-wheeler fleet, where electric models are becoming more popular as well, accounting for around 10% of sales. This demand shift is also creating industrial opportunities, with Southeast Asia positioning itself as a manufacturing hub for EVs and batteries. Today, it's the preferred destination for Chinese overseas investment in EV manufacturing capacity, with Thailand and Indonesia being two countries where large factories are being hosted today. So looking ahead, sustaining this momentum will depend not only on vehicle supply and charging infrastructure, but also on financing models that can reduce upfront costs for consumers. Back to you, Adam.
Thanks so much, Lauren, for those insights on Southeast Asia, particularly your focus on the power sector and also end use. So that ends our presentation section of our webinar. So we'll now be taking a short 2-minute break. I can see lots of questions have already come in on the chat, but please do keep them coming. We'll be reviewing those and then we'll come back after that short break and then we'll try and get through as many of them as possible. So please stick with us, short 2-minute break, and then we'll be back here to answer those questions. And thank you very much to all my presenters as well for that. That was excellent, but look forward to continuing the discussion shortly. Thank you very much and welcome back. Thank you to all of those that have submitted questions. I want to first turn to Zoe for the United States. So we've had a couple of questions around, understandably, how the current events in the Middle East are expected to impact oil and gas investment in the United States. So I think if you could tackle that one first, that would be great.
Yeah, happy to. Thank you, Adam. Indeed, I think this is kind of a question that's on everybody's minds, so definitely important to address here today. And I think what we've been able to observe so far is that oil and gas investments in the United States really have a lot of inertia behind them. So far, we haven't necessarily seen huge disruptions in long-term investment planning by oil and gas companies in the United States. But of course, this is something that we're tracking very, very closely here at the IEA, and is also something that we'll be diving into a bit more deeply in the context of the World Energy Outlook for 2026, at which point we'll have been able to see results from the second quarter of this year. However, what I can say for now is that, of course, this World Energy Investment Report was written in large part during this conflict, and so this is something that we anticipated as being an important question to address. And one way that we did so with the absence of real-time data was by looking at how investments have responded to previous oil crises. And so what we're able to see, for example, for the 1973 oil crisis, is that in the years following that crisis, upstream oil investments really started to go up in importing countries. But I think the important sort of caveat to note here is that that trend was really observed over a period of several years and not months. And so I think we still have a long way to go before we start seeing the real world impacts in terms of investment of the conflict. However, I think one way that we can also anticipate the response to this conflict being a little bit different from that of the 1973 oil crisis is that, as we were able to sort of understand from my colleagues earlier during the presentations, a lot of countries might shift towards alternative sources of energy, on one hand coal, but on the other hand low emissions power like nuclear, geothermal, and renewables, to reduce their dependence on oil and gas imports.
Great. Thank you very much, Zoe, for that. Sticking with the energy crisis, and maybe Sid, I could turn to you next, because I see we've had a couple of questions around how the energy crisis has affected the landscape for energy investment in India. So if you could please tackle that one.
Sure, thank you, Adam. So India's situation is markedly different from that of the United States, being a net importer of energy. India, in fact, as I'd mentioned in the presentation, imports about 80% of its crude oil needs. In fact, it gets even more accentuated with certain fuels and sources. For example, India's reliance on the Strait of Hormuz for its LPG imports has increased over the last 10 years or 5 years, which has meant that as India's getting closer to universal use of clean cooking fuels, it also is greatly reliant on obviously a volatile region. So as India's been a net importer for obviously many decades now, India's energy policies have always preferred a sense of security baked into its very nature, as a result of which India's had a big focus on the power generation side on domestically mined coal, which has been the backbone of India's electrical system. Also, obviously, hydropower, which is largely domestic, and with some imports from neighboring countries. And in the case of the last maybe 5 or 10 years, is this big push on modern renewables, namely solar and wind, that have seen acceleration. On the transport side, India's in recent years had a focus on the blending of ethanol in petrol. So India's in fact reached 20% blending already, which means that 20% of energy demand for road transport for petrol-based or gasoline-based cars has been avoided through these policies. Now, when this crisis hit this year, as Zoe mentioned, of course, there are some some trends that will emerge only in the coming weeks and months, because many investment decisions are baked in. But there are short-term decisions that were made by consumers who felt a shortage or an impending shortage of LPG, and so we saw already in just a few weeks a 20-fold rise in the sales of induction cook stoves.
Wow.
And this was a very big, massive jump. In fact, the inventories ran out in across online stores as well as physical stores. Um, as I spoke to my family and my friends in India, we found that people were actually shifting and moving to using induction cooking for maybe a meal a day, or occasionally, so just to avoid exhausting their LPG reserves at home. So as a result of which, we already see some impact on energy investment. It's baked into our numbers here, and of course we will be tracking this moving forward as well.
Great. Thank you very much, Sid, for that. Pat, maybe I can turn to you next, and a question we've received on Africa specifically. So what are the current trends in how oil and gas companies are investing in renewables and also the broader energy transition?
Yeah, thank you, Adam. Really, as we have seen in Africa, the largest component of investment actually remains oil and gas, right? But distributed in established producers countries and emerging countries. But we also have in the other side clean energy investment, which is like increasing and is expected to reach 50 billion in 26, which is quite interesting number. But we also have the critical mineral, which is a growing segment right now, and which reflects the role of Africa in terms of supplying material for clean technologies, right? So we have for critical minerals, it's a very important topic because the growth over the past decade has been from 14 to 90%, and it reflects actually the global rise, the global demand rise, and the continent resource potential. But at the same time, around oil and gas companies, most of them are right now diversifying their portfolios, not only on hydrocarbon, but also in renewable power infrastructure and low carbon technologies. However, the pace of diversification, I think, will vary depending on the region and the context.
Yeah. Great. Thank you very much, Pat, for that. Maybe, Marta, I can turn to you next, specifically on Europe. And we've received a question. So how is planned investment in nuclear evolving in the EU? And what role is it expected to play in the future energy mix? Because we're seeing, a lot of announcements, a lot of interest in nuclear. So please.
Okay, well, thank you. For the question, I would say that nuclear in the UA is recovering. We are seeing a strong interest in improving the lifetime of the centrals, and also new builds. We've seen also that the European Union has announced 200 million investments in SMRs, so that will help to develop the sector. And how how it can get into the electricity mix, I think it will play a complementary role in low emissions electricity with the renewables.
Thanks very much, Marta. Next, if I could turn to Lauren for Southeast Asia. And, when you presented there, you showed how important coal investment has been for the region. So as a region where coal is important for energy security, how can a transition away from coal be financed?
Right. I think as some context, Southeast Asia kind of sits at the intersection of a lot of challenges that makes it quite difficult for a coal transition. So electricity demand is growing, their coal fleet is young, there's policy pressure to reduce emissions, but also governments need to maintain affordable electricity supply. And I think the first thing to say is that any transition away from coal, any financing will have to be integrated into power systems planning processes, and it has to be realistic to each country's needs. And the IEA has done a lot of analysis on coal transitions previously, and we have been looking at different emissions reductions levers. So I think the most obvious one is to retire a coal plant early, but there are also levers such as repurposing a coal plant, co-firing, or using CCUS technologies. And I think in general, financing mechanisms need to provide a lot of incentives for plant owners to either retire their assets early or to limit their operations. And this makes it quite challenging because historically there have been banking exclusion policies and uncertainties over whether coal can be treated as a transition pathway. But I think in Southeast Asia, there have been recent transition finance technology taxonomies and frameworks that have been clarifying how coal transition activities can be financed. I think here there's also a big role for international public finance in supporting these transactions, where they can test out innovative financing mechanisms, such as transition credits, which is being tested in the Philippines. And so I think the last thing to say is that the effectiveness of any financing instrument really depends on the context, and it depends on the country. Between a country like Indonesia, where there is a lot of coal supply, with other countries that import their coal, I think the financing mechanisms would differ. And I think the final thing to mention is that any financing of a coal transition will need to address just transition. So addressing the impacts on employees and communities that are reliant on coal.
Great. Thank you very much for that, Lauren. And Marta, if I could turn back to you again, but this time thinking about Latin America, and we saw in your presentation how you outlined the investment in oil and gas across the different countries in Latin America, but we've received a question on which countries are leading renewable investment in Latin America, and what trends do you see that stand out across the region?
Okay. Well, it's similar, like Brazil is leading the trend, particularly in wind and solar. Chile is also standing out with solar, storage. Other countries such as Mexico, Argentina, and Colombia are also developing and investing in this sector, but they are having like some delays for the regulatory uncertainty. I think there is a strong interest, but they have like some challenges. For example, with the grid infrastructure and the permitting. So maybe it's going like slower than expected, but they are.
Okay, great. Thank you very much for that. So we've had a question now which has highlighted that, yes, in the report we see strong growth in clean energy investment globally, but a lot is still concentrated in China, the US, and Europe. And what specific policy or financing mechanisms have been most successful in attracting large-scale clean energy and grid investment, and particularly thinking about emerging markets? And here the question is interested in knowing how these policies that have been successful, how they could be replicated in South and Southeast Asia. So maybe I'll turn to Sid first, and then after Sid I can come to you, Lauren. Is that okay? Okay, Sid.
Sure, Adam. Happy to take this on. So maybe I'd like to talk about where India's financing usually comes from, where a large part of the flows originate, because I think it kind of reveals a bit about the structure and nature of India's energy economy. So a large share of India's energy investment is actually met from domestic sources. This has historically been the case, and as we have spoken to a lot of Indian stakeholders, a lot of the Indian major energy companies, we find that they see that domestic sources will continue to be the mainstay for them. So the reasons for that is that India's macroeconomic and other conditions can at times be a little volatile. So we find, for example, that India's currency depreciation has been quite high in recent months. In fact, with over 10% depreciation over the last year. In fact, it's not been one of the best performing currencies in this period. This adds to, of course, the expectations for returns by players internationally. Also because India not being a supplier economy as a demand focused economy, of course the electricity sector tends to be regulated for good reason, and therefore it's not seen as a place for international investment to kind of largely focus on. Having said that, there are some companies that have done really well in attracting international sources of investment through modern corporate structures, and of course also promising interesting returns that address some of the risks that international investors are usually concerned about. So I'm happy to also talk about the risks, but perhaps that's a separate question. I'd like to focus on just understanding what is it about the nature of India's kind of energy sector that leads to these kinds of trends. And so we find that big energy companies are able to uh, accept and attract international investment at certain times. Those times are usually when a few kind of variables fall into place at the right time. So a few months of reasonable currency depreciation or currency price movements, also maybe an investment climate and expectations of new policies or new policies that may have come in. So there are certain times when we find spikes, but for the most part, it's domestic sources that form that backbone of India's investment flows.
Great. Thanks very much, Sid, for that. And Lauren, if I can turn to you. So now the perspective of Southeast Asia.
Yeah, I think because Southeast Asia is such a diverse region, I can't really say definitively what we could do to attract large-scale investment. I think in general, the cost of capital in the region is around twice as high as in advanced economies and in China, and that reflects a lot of country-level macro risks. And I think addressing these macro-level risks, such as through concessional capital, could be very helpful in mobilizing investment in these regions. I think another thing to note is that I think one thing that's worked quite well in Southeast Asia, particularly for smaller scale projects such as off-grid solar or clean cooking, is with aggregation, because a lot of projects have been super small and very fragmented, and institutional investors don't want to come in. But there have been a lot of cases of aggregating smaller projects into larger projects that are more interesting to commercial investors, let's say. And I think another thing to note is that Southeast Asia is a testing ground for a lot of innovative solutions. And so there are a lot of blended finance platforms such as FastP by Temasek in Singapore that have been testing out different technologies and financing mechanisms to mobilize investment into the region. But also there's been a lot of testing with carbon finance. So a lot of carbon credits related transactions are coming online in these regions as well. And so I think there are a lot of ways in which Southeast Asia has been giving some interesting examples of new financing mechanisms.
Great. Thank you very much, Lauren, for that. Sadly, that is all we have time for. I'm sorry we didn't manage to get through all of the questions, but I do encourage you to please go and check out the World Energy Investment 2026 report. It's freely available online as well, that interactive dashboard that I mentioned. But lastly, I just want to say a huge thank you to my colleagues who all led on their different countries and regions in the report and provided their expert insights and analysis. And of course, thank you to everyone that has joined us online. So thank you very much and goodbye.